Yeah, so in almost 11 years of managing this fund, we've never had a down year. And so asset preservation is obviously very important to us. And so, the way I think we've been successful is sticking to our deep value approach on both the bond and equity side. So in equities, we're really focused on buying securities at a discount to book value, which gives us a margin of safety when things get volatile. On the bond side, if volatility causes forced selling in something like mortgage-backed securities, we want to make sure that we're buyers, not sellers at distressed prices. The other important factor is, we're very focused on parts of the market that have fundamental stability where we don't have to make significant credit bets. And so when volatility hits the market and things get emotional, we're not in a position where we're second guessing the stability and the safety of the underlying assets. Yeah, so first I think it's important to realize that the publicly traded real estate market provides plenty of investable securities that will do well in a rising rate environment. And so in our equity bucket right now, we're focused on mortgage companies that have balanced business models and attractive investment portfolios, which includes exposure to mortgage servicing rights. And we've talked about it a little bit in the past, but mortgage servicing rights are poised to appreciate in value as interest rates rise. The other part of the market that we like in equities are preferred shares off of mortgage REITs that either originate or invest in floating rate loans and use securitization as a funding mechanism. On the bond side, we like legacy RMBS that has negative duration and also short duration, high yielding corporate bonds. And so overall, we're very focused on high yielding securities that we think can do well in any interest rate environment. Yeah, so if you take a step back and you think about the market for publicly traded real estate securities, you have residential and commercial property types, and then you have a capital structure ranging from government guaranteed mortgage-backed securities all the way down to common equities off of REITs and other real estate related companies. And so right now, we think residential housing and mortgage credit is in a very stable place fundamentally. We are slightly bearish on commercial real estate, and we think bonds in general will face a hard time as interest rates rise this year. And so if you put all of that together, we want to be invested down in the capital structure on the residential side. And so about 2/3 of the portfolio right now is invested in residential mortgage-related equities, where we're focused on high dividend yields and low price to book ratios. A lesser portion of the portfolio is invested in short duration bonds, which includes legacy RMBS and high yielding corporate bonds. And so, in the short to medium term, I think this asset mix puts us in a really good position. But as fundamentals and market pricing inevitably changes, we want to make sure that we're relatively nimble to change as the market changes.